Ladies and gentlemen, good day and welcome to the SP Apparels Q3 FY23 Earnings Conference Call hosted by Elara Securities Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Prerna Jhunjhunwala from Elara Securities Private Limited. Thank you. Over to you.
Thank you, Ryan. Good afternoon, everyone. On behalf of Elara Securities Private Limited, I would like to welcome you all to Q3 and 9-month FY23 post-result conference call of SP Apparels Limited. Today, we have with us the senior management of the company, including Mr. P. Sundararajan, Chairman and Managing Director, Ms. S. Shanta, Joint Managing Director, Mr. S. Chenduran, Joint Managing Director, Mrs. S. Lata, Executive Director, Mrs. P.V. Jeeva, Chief Executive Officer, and Mr. V. Balaji, Chief Financial Officer of the company. I would now like to hand the call to the management for opening remarks. Thank you, and over to you, sir.
Yes, thank you, sir. Good afternoon, everyone. A very warm greeting to all of you present on the con call to discuss our Q3 financial year 23 performance. I hope and wish that everyone and their loved ones are hale and healthy and safe. I would like to update you all on the buyback that the process is complete. Let's discuss on the performance of the company division wise. Garment division. Our garment division revenue for this quarter stood at 219 crores versus 219 crores of Q2 FY22. Q3, okay, which is flat year on year. Total exported quantity stood at 13.3 million pieces. This quarter, we saw some pushback from the retailers, mainly due to the inventory pile-up with the retailers because of the container issues that happened during the month of October 2022. Our adjusted EBITDA of the garment division stood at 40 crores for the current quarter, 17.7% versus adjusted EBITDA of 20.2% year on year. Our current order book stands at 364 crores. Capacity utilization as of today is around 74% and is expected to increase by around 10 to 15% going forward. We have started working with 2 new customers, one out of US and another one out of Russia. We expect traction with these customers in coming quarters. On the FTA front, we are looking for the FTA to be signed off by end of March, hopefully. As we informed you earlier, our new factory at Vakasi is under process, and there is a push in the start of the process due to clearance from competent authorities. We expect the project to be completed up and running by April 2024. With regard to the spinning, last 3 months spinning production was reduced due to the high cotton price and low yarn realization rate. Hence, margins from spinning plant was negative at the EBITDA level during the quarter. Further, cotton prices have corrected, and now we hope that cotton price will continue to correct. Spinning plant shall contribute to the margins going forward. For information, the yarn price is now stable. With regard to the processing unit, in spite of the coal availability issue and the rise in the input cost, our processing division was able to perform well with good utilization levels and contributing to the margin effectively. With regard to the subsidiary SP Apparels UK Limited, it has seen a lot of disruptions in supply chain, majorly due to the container issues. It is yet to recover. Slowly it is recovering now. Revenue for the quarter stood at GBP 1.12 million as against 2.12 million quarter-on-quarter. SP UK has made EBITDA break-even as against 2.9% Q-on-Q. I am confident that SP UK will be able to come out of the crisis and will be able to do well going forward. With regard to SP Retail Ventures Limited, currently we have 60 stores under all brands. We have opened 2 new stores for Angel and Rocket in Bangalore, and it is doing well. We have also opened stores for Head, which is also doing well. SP Retail Ventures made a revenue of 21 crores and made an EBITDA loss of 1.8 crores for the current quarter. Crocodile has been making profits continuously, and however, the new brands that we have added and their fixed overheads are pulling down margins. We firmly believe that the other 2 brands that we have added will perform well, and we are confident that with brands like Crocodile, Head and Angel Rocket and also Natalia will do well in the future. Our current liquidity is, after making rupees 35 crores buyback, still our liquidity position is very strong, and we have serviced all the debt up to date. Thank you. Now over to CFO, Mr. Balaji.
Thank you, Chairman. Good afternoon, everybody. I just run through the presentation or the financial performance of the company. For the current quarter, we have made a total revenue of 258 crores on an adjusted revenue basis, and we have made an EBITDA of 38 crores and a PBT of 19.43 crores and a PAT of 13.2 crores. On a 9-month basis, we have 825 crores as against 609 crores year on year, and an EBITDA of 134 crores as against 103 crores, with a PBT of 85 crores as against 78 crores year on year, and a PAT of 62 crores as against 59 crores year on year. On a division-wise performance, our garment division made a revenue of 290 crores for the current quarter with an EBITDA of 17.7 crores, and our UK did a revenue of 11.15 crores with break-even EBITDA, and our retail division did 20.87 crores with an EBITDA of minus 8.96%. Now, on the debt position, as on 31/12, we have a long-term debt of 38 crores, short-term debt of 124 crores, a gross debt level of 168 crores. We have 78 crores in terms of cash and cash equivalents. So my net debt position as on 31st December is only 84 crores. On the working capital, we have 265 crores as inventory as on 31st December, and we have account receivable of 59 crores as on 31st December, and an account payable of 50 crores as on December. So my net working capital is 274 crores. So other information are available in the presentation, and we'll get into the question and answer.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question comes from the line of Shika Mehta from Q3 Capital. Please go ahead.
Good afternoon, sir. I just have a couple of questions. Looking at our presentation, what I understood was that our EBITDA has been pulled down due to the MTM forex loss of 8.5 crore. So is my understanding right that there will be a reversal of this next quarter and it should result in an improvement, say, next quarter?
So we have made a EBITDA gain last year, and the reversal of that, because if you recall what happened in the month of first week of October, there was a change in the Prime Minister candidate in UK. So inflation in pound and euro was severe. So we had a gain last quarter, and there is a reversal of that. In fact, is 8.9 crores.
Okay, so this 8.5 crore is more of a reversal of last quarter than something that will be reversed next quarter, correct?
Yes. Correct.
Okay, sir. And so another thing I wanted to understand was if you look at the garment sector as a whole in the media, there has been a lot of negative news floating around. Today there was an article in the newspaper about certain garment manufacturers that are not doing well and haven't been able to pay their portion of the EPF. Can you throw some light on how the garment division is doing overall and how we are seeing this going forward?
Yes, generally there is the inventory for the retailers. The inventory management is a little bit chaotic due to of the post-COVID and the container issues, and so there has been a big mess up because they bought a lot for the last Christmas, but now slowly they are getting into the ground reality of the real picture that there is a mess in most of the retailers' inventory, the stocks. So they really don't know which one to buy, which one not to buy. That's the kind of a situation. So they are just holding everything, and gradually now they are releasing the orders. For example, one of our customers, suddenly they said that for another 2-3 months no orders. Then within 1 week to 10 days, they placed 3 million pieces orders. So this is the kind of situation, a confused state. So what happens? So here the customers, they do not give preference to the small players, small manufacturers, because most of the retailers rely on the big manufacturers. So that is why now the big factories are able to manage, but the small factories are not. This is one thing. And during this current scenario, the retailers are trying to consolidate that. So naturally, they want to reduce the number of suppliers and push the business to the big manufacturers, and they are asking us to increase the capacity. So this is also happening. So there are different. There is a mixed view with regard to this industry. The small players will say there is a recession or no orders, but big players are majorly affected.
So to consolidate everything you've said, we should benefit from here because of consolidation and our niche segment, correct?
Definitely, we are expecting to. We stand to gain in this situation. In the consolidation, we will be one of the preferred factories by the retailers. It's a question of time, 2-3 months.
All right, sir. So another thing I wanted to understand was now we're almost midway through this quarter, through Q4. How are we seeing our demand and margins shaping out? And if you could also shed some light on our spinning segment and if we can see that turn even break even or turn positive.
So you are looking at Q4 performance, right?
Right. And also about the spinning segment and the margins.
Spinning, as Chairman spoke about the cotton prices coming down, I think still the correlation between or the margin spread between the cotton prices and the yarn prices is very low. So I think once the demand in terms of yarn picks up, then spinning also should be in line. I think by March, things should be back.
Okay. Okay. So Q4 also, the spinning unit might see a rough quarter.
Maybe not as bad as Q3 or Q2. It should be definitely be better comparing Q3 and Q2.
Okay. And also, we had alluded to around 20% growth for FY23 and FY24. After our Q3 performance, are we still holding to those guidance?
So, like we have not said 20%. We said anywhere between 15 to 20%. So we still feel that 15 to 20% should be possible.
Okay, for FY23 and 24, right?
Yeah.
Okay, sir. I'll join back in the queue. Thank you.
Thank you.
Thank you. Our next question comes from the line of Aman Agarwal from Carnelian Capital. Please go ahead.
Good afternoon, sir, and thank you for the opportunity. A few questions from my side. First was on the volume decline. Like, once you see our volumes, like they have come down from 16 million units to around 13.4 million units. So, if you can touch upon like what is impacting this and how we see volumes basically panning out in future, like in next few years.
So on the volume for the current quarter, in the opening remarks, the chairman spoke about the pushbacks that were happening. So and we have guided for a 25% growth for the current year, FY23, and we still feel that 25 to 30% of growth for the current quarter, for current financial year should be possible. And for FY24, as last caller asked about the growth, we still stick to the guidance of 15 to 20%.
Understood, sir. So in terms of production, if you can tell me like what was the production in terms of pieces for this quarter? Like, was it just the inventory impacting us, like inventory with the retailers, or even on the production side we have produced less garments during this quarter?
You are talking about the inventory stuff?
So I'm asking the production volume for this quarter, like in garments.
See, those numbers cannot be provided in terms of quantity. So you can look at the number for the whole financial year. We could anywhere be between 58 to 60 million pieces.
Got it, sir. And in terms of the our capacity utilization and labor addition, so if you can give me any number, like how much labor we have added during this quarter, like since the start of this year, so that would give an idea about how our labor procurement is basically going on the steps we have taken over the last few years.
So in the opening remarks, Mr. Sundar has spoken about the current capacity utilization of 74%, and it can be increased by 10 to 15% going forward. So that's where we are looking at in terms of utilization level. In the next financial year, we should be at somewhere around 80 to 85% in terms of utilization.
Understood, sir. And like we mentioned it in our opening remarks that the new capex for garment facility that will be ready by April 2024. Is that right, sir? Or like because that is like 1 year from now. So what is causing this delay in the capex for the garment facility?
So in terms of the delay, again, Mr. Sundar in his opening remarks has spoken about the delay because of the approval that needs to be taken from the competent authority. So that's the cause why it is getting delayed. But we are on it, and we hope that things is almost at the finishing stage, and we should start working on the factory from April onwards. Yeah, I'm talking about the building getting started.
Understood, sir. Just a final question on the retail segment. Like, so this is still making EBITDA losses, like around 9% for this quarter. So any internal target we have to basically achieve EBITDA break even in this business? Any internal timeline we have?
See, the new brands, the Angel and Rocket and Head, we have started working with these brands only for this year. So opening up new stores, opening up point of sale with the LFS channel was a tough task, and we have opened up. So we have opened up with so many LFS channels like Shoppers Stop. We have opened up with Centro. We have opened up with Central. So we are equally working on improving the presence of the brand. So whatever we have put effort during the current year will start yielding results next year. So we expect that next year we should do a better EBITDA margin for the retail ventures.
Understood, sir. Thank you, and I'll join back in the queue. Thank you.
Thank you. Ladies and gentlemen, a reminder, if you wish to ask a question, please press star 1. Our next question comes from the line of Prerna Junjunwala from Elara Securities. Please go ahead.
Thanks, Ryan. Sir, I wanted to understand the demand scenario with respect to kids and infant segment. Do we see divergent demand behavior as compared to adults in current scenario, or is it largely similar to the entire garment demand right now?
Can you come again, please?
I was asking on the demand scenario for the babies and kids segment that we are in as compared to the adult segment. Is there any divergence in the demand scenario for other segment that we are looking for, especially with respect to recovery rather than the current scenario? And second, are we also looking to expand our product basket to the adult wear?
Yes. See, currently the kids, as I always say, that kids and babies are always in demand. But now it is not, there is a little bit of the demand has, it's not dropped, it is going very, very steady. But the retailers are just waiting and watching to buy the next round of buying. When compared to men's and ladies, definitely kids and babies are doing better, and which is always good. And we are definitely, as I mentioned, because of the consolidation happening, customers also wish to us to increase our departments to men's and ladies as well. Because those factories, our factories who can handle the babies and kids can easily manage ladies and men. So we are getting the business of men's and ladies gradually from our existing customers. So this is a part of the consolidation again, not only in babies and kids. While consolidation is happening, they are asking us to do even the adult business.
Oh, great. So what is the current contribution of adult wear in our current revenue, and where do we envisage this to be in the next 3 to 5 years?
Current percentage is about maximum 7 to 10%, and we anticipate around 20% by end of next year.
Oh, that's pretty good.
Yeah.
And second question is on average realization. This improvement in average realization that we've seen this quarter, is it also because of the change in product mix, or is it a factor of only cotton and it will revert back to normal levels when cotton prices come down?
So the average realization increase is a combination of both. There is some increase in the material cost, because of which the selling price is getting increased, and also because of the mix that is happening, it is also increasing. So it is a combination of both. Quantifying the percentage will be very tough. The yarn prices have started coming down. Maybe next quarter you will see that the average realization is coming down.
Okay. Sir, there is also supply disruption from Turkey and Pakistan too, and they are large suppliers to Europe. Are we seeing any benefit because of disruption in supply chain coming in to our company?
Yeah, definitely the customers are reluctant to place orders with Pakistan and Myanmar and also Bangladesh, because Bangladesh recently the wages, the workers unlessness, because the wages, they want the wage to be double, more, 5 times, 4 to 5 times. So even if they settle it 2 times or 2.5 times, so they are going to be expensive. That's number one. And say the Myanmar, Pakistan, they are not in politically not stable, and China definitely still that with anti-China sentiments is still happening. So in addition to that, if we get FTA, so all the more benefit.
Okay. Okay, but are you seeing additional inquiries coming in because or?
So yeah, it is coming. It is coming. I mean, see now currently they are just settling down with the managing their inventory, the stock levels. So probably from April onwards, there will be an aggressive placing of orders. We expect.
Okay.
Until between April to July. Sorry, from July onwards there will be an aggressive placing of orders.
From July onwards. So
yeah,
Q1 is also likely to be soft in your opinion.
Yeah, no, we are getting the for our capacity, no issue. For additional increase, due to the consolidation, these things will happen from July onwards.
Okay, understood, sir. So I'll come back to the question queue. I have 2 more questions. Thank you.
Thank you. Our next question comes from the line of Ashwin Reddy from Samatwa Investments. Please go ahead.
Yeah, hi, good afternoon, sir. Thank you for the opportunity. So I have a few questions. Firstly, on the top line, some clarification. So given that in the first 9 months, we've done approximately 32.5% growth in the top line. So for for the current year and for next year, what is the broad numbers we need to work with in terms of top line sales? Because there's some back and forth, and I'm just trying to get clarification in terms of FY23 and FY24.
FY23-24, we I think in a couple of weeks before we have given a guidance of anywhere between 15 to 20% of growth is possible.
No, this is FY24. So for FY23, you're saying like 25 to 30 is what you need to work with?
Yeah. See, we have completed 9 months. Right. In terms of quantity, we have done a 35% of growth 9 months. So we expect to complete anywhere between 25 to 30% for the current financial year.
Okay, fine. Okay, this is helpful. Secondly, on the margin transfer, so one, because of the current demand scenario, has there been any pushback on the margins for us? I mean, has there been any in terms of, in our talks with with the retailers, has there been any pushback on the margins?
There cannot be pushback on the margins, but definitely when you compare the cotton prices or the yarn prices increase, the same incremental revenue is not coming. If, say, for example, there is an increase in yarn prices by, say, 30%, the same 30% increase on the output is not there. So there is a reduction. So net only 10% is given as sales realization. So definitely there is a pressure in the margin because the spreads are coming down. But now, off late, where the cotton prices have started coming down, yarn prices have corrected. So we feel that we should be in line with the guidance of 18%, what we have already guided for.
Okay. But
consolidation, so the volumes will go up, but there is a big challenge on the price negotiation, which we have to mitigate, in other ways, like, managing by better efficiency, wastage, and overhead control. So we will definitely able to manage and maintain that 18%.
Got it. But in case we take the next 2-3 years, given that we are guiding for an increase in the menswear and women's wear, if that proportion increases in your overall sales, would that mean a lower margin table for you in the next 2-3 years, as the proportion of the sales might increase faster, but will the margins dip because of the increasing proportion of menswear and women's wear?
See, the margin will not increase because, the most competitive products are.
No, I'm saying will it decrease? I'm saying will it decrease because of the menswear, women's wear? Will the margins decrease because of that?
Correct. But yes, in terms of percentage, there will be a decrease in the margin. That's the challenge which we have to manage it.
But we'll have more of fashion in baby wear and kids wear. So we'll get better margin. So the overall, we'll be able to maintain that 18 to 20%.
Oh, you're saying in spite of increasing the menswear, women's wear in the next 2-3 years, still the margins can be maintained at 18% above is what you're saying?
Yes, yeah.
Got it. This is helpful. And finally, sir, on the could you comment on the overall demand scenario and compare between the current scenario in US versus UK, because US is still very small for you, but you're making inroads there. Any thoughts on the US versus on where UK is overall and where Europe is? If there's any differentiation.
Better than UK and the Europe. That's again because of this Russia-Ukraine war thing. So it will settle down in about 6 months' time, hopefully. So again, we are, because of consolidation, generally the industry, yes, there is a problem in the Europe and the UK. But as far as we are concerned, our business is being protected with our existing customers, and we are planning for adding a few more customers. But this is not the right time to add new customers at the moment because everybody is doing the consolidation. So we will keep for another 1 year to add new customers. But when compared to US, Europe and UK are not that great.
Okay, got it. And the last question I have is on the retail business. So what is the scale that you're looking at, or what is the numbers in terms of stores that you want to have in the next 2 or 3 years? So if you put together the existing Crocodile plus Angel and Orchid plus Head, what is the numbers that the broad plan that you have for the next 2 or 3 years?
You wanted a specific number?
Or an approximate number. I mean, so it's just to know how you're thinking about the scaling up part of the retail part of the business.
We are looking at close to 120 crores of revenue next year, with Angel and Rocket and Head, Crocodile, Natalia. Maybe Natalia will take some more time for us to operate. We will put in use into Natalia. But we are looking at 120 crores of revenue next year, where we should be in a position to do 8 to 10% of EBITDA for the whole year.
Got it. So thank you so much. And good luck.
Thank you.
Thank you. Our next question comes from the line of Neeraj Mansingha from White Pine Investment Management Private Limited. Please go ahead.
Thank you for the opportunity. I just wanted to know, Sundar, how many is the employee count at the end of the quarter?
So this quarter we should be close to around 12,500.
12,500. Okay. So last quarter we had said that we had added 500 employees during the quarter. But so has there been a shrinkage of employees, or is it just a normal?
No, see, this quarter, because of the Diwali time, usually there will be reduction in employee strength during Diwali because people used to go to their home states, they don't return back. And moreover, there is a number of working days in this quarter is also low. So usually Q3 the numbers will come down, then start picking up from April onwards. That's how it is for the whole industry.
Got it. So what is the target? How employee addition that you are looking at there onwards?
So target in terms of employees as we are purely based on employee strength. So when we talk about the 10 to 15%, 15 to 20% growth next year, we are looking at a 15% growth with employees also.
Got it. Yeah, that's all. That's all from my side. Thank you.
Thank you.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star 1. Our next question comes from the line of Gunjan Kabra from Nivshay. Please go ahead.
Sir, thank you for the opportunity. So I wanted to understand that you have guided 18% EBITDA margins to be sustainable. And as far as I understand, in 2021-2022, when we were able to do 16 to 18% EBITDA margin, that time, sir, the yarn division or yarn sector was also spinning sector as a whole was doing pretty well. Like, all the spinners were also performing very well. So that kind of helped us also, I feel. Then after that, now when the spinning division is not doing, when the spinning sector as a whole is not doing well, it's not able to pass on the prices, so our margins have deteriorated. So when if we going forward, if we assume also that it stabilizes or stabilizes, then how are we seeing the margins to be 18%? Like, how does that trajectory work? I wanted to understand that.
So, like if you comparing others, it all depends on the size of the capacity is very, very important. So for us, we have a 27,000 spindle capacity, which purely works only for our captive purpose. And we have a leased capacity, which also works for the captive purpose. So, I don't think you can compare the spinning as an industry and compare P Apparels because we are purely backward integrated, and whatever excess production we do in one is being sold outside. That's how we work. So, your question in terms of comparison may not be right, but in terms of percentage of guidance of 18%, since we feel that the yarn prices have corrected, and we expect spinning also to contribute to the overall standalone as a company, and that's where we are guiding 18%. If you recall, our last 2 calls, we have been saying that because of spinning, our margins are under pressure. And if you look at last year, our EBITDA margins were close to 21%. That was also because of the spinning.
So correct. So that is what I wanted to understand. I understand it is for just the captive use that we do. So when the yarn prices were high, it helped us also in a way when we were able to do 18% EBITDA margin. So I wanted to understand, even if the prices of yarn goes down going forward, how will we be able to maintain those 18% margins? And in the previous year, when 2021 and 22, when yarn prices were high, we could do around 16 to 18% EBITDA margin, whereas in the previous years we were doing around 14%, 15%, 13%. So I wanted to understand if going forward the yarn prices also doesn't move and so still will be able to maintain 18% EBITDA margin.
See, it is not about the movement of yarn price alone, right? Spinning is between cotton to yarn. So the spread between cotton to yarn, if it is sustainable over a period of time, then there could be margin. If the cotton price is higher and your yarn realization is lower, then the margins are squeezed. So whenever we take orders, we take only the current market yarn price because every competitor works only from the yarn price. So the customer do not from the cotton price, he works from the yarn price. That's where the difference is.
Okay. So also one more question I had. So if you can guide, what would be the difference in EBITDA margins when we cater to children baby wears and when we cater to adult and men and women wear? So if you can guide the difference in the EBITDA margins, will that be possible?
So see, if you wanted to work deep, then the costing in terms of men and giving children would be all same, because if the stitching time will differ for children and for sorry, the voice is breaking.
Yes, sir.
Give you the margin breaker for adults or kids or babies. See, because it is our internal working where some orders we take in order to fill our dyeing capacity and the yarn production capacity, and sometimes we take orders and even cost to cost to fill our sewing capacities to avoid the overhead. So it's a combination of everything, and it's closely we monitor every time when we receive an order. So the cumulative benefit. On one hand, we have to see fill the capacity. On the other side, to the costings and the competition. So we cannot practically give the individually for segment wise the margin.
Okay. Okay. Okay, thank you, sir, and good luck for your future endeavors. Thank you so much.
Thank you. Our next question is from the line of Nirav Survey from Abacus Investment. Please go ahead.
Hi, sir. My question is regarding the retail business. So what went wrong in this quarter? I actually missed the first few minutes of the call, but is there anything which went wrong in the quarter because we have reported losses at EBITDA level in the retail business?
No, we have made a top line of 21 crores and we have made a 1.8 crores at the EBITDA level losses. So the losses is purely because of the fixed overheads that the new brands are carrying and which is not supported by the top line. So that is where I said in the beginning that these brands which are new are now needs to be presented in all the point of sale. So now we are coming up with new LFS channels. We need to be present in all channels. So we are in the process of putting up all the channels, and now we are present in lifestyle, we are present in Shoppers Stop, Central. So we have started working with all. So I think next year will be the year where we will see all these brands coming up, and our EBITDA should be positive there.
So in Q4 also, do we see anything changing as far as the retail business is concerned, or would be still at the low margin or loss making?
Basically, see, crocodile is predominantly that's a large chunk of the total business, which does about 80%, I think, 80 to 85%. So which has turned around, which is the margin is sustainable now. There's been continuous EBITDA plus in crocodile. So which means the 85% of the total business is profit making now, and this being rocket is a new business, and so which needs to break even at certain level. It would take about 2 to 3 years time. Already we have crossed 2 years of time. In between COVID came, all got disturbed. So maybe next year we are hoping that we will be increasing the turnover of Angel and Rocket by increasing the presence in various channels. And we are same way for head also. Head is already, if you look at the head, the margins on costing is better, but only the overheads are pulling it down because we have to increase the number of outlets by which increase the sales. So Angel and Rocket, leaving Angel and Rocket and head, the retail business is definitely very, very attractive and profitable. So since we have taken these two also, so it means it's minimum time to break even, which is happening now. So FY24, we are confident that there will be the EBITDA plus, about 8 to 9%. That's what we are expecting, putting all together.
Okay. Right, and what is our exposure to pound if we see for the third quarter, because we had a M2M loss on Forex. So what would be your exposure on pound?
Pound exposure, we should be close to around 45%.
45% is pound. Okay. And going forward, will it be continue to be higher? Because I understand a lot of our receivables are also in dollars, which we had reduced the pound exposure and increased the dollar exposure. So we were selling in USD to a lot of our UK clients as well. So has anything changed there?
No, nothing has changed. I told you, I think you missed the query which came up in the first. So, see, we have been LTM gaining for past 2-3 quarters, right from Q4. We were making closely around 13.5 crores of gain. And suddenly, because the quarter, because of the change in the Prime Minister candidate in Q3, there was a big change in the currency. So that's why there is a hit in the current quarter. It is a reversal of last quarter's gain which we have recognized. So ultimately, whatever margins which we book now, which we show as an adjusted EBITDA margin, is without NCM only. So this is purely a reversal of the impact of last 2-3 quarters.
Okay. Right. In this deferred revenue which we had, I mean, there was some deferment of order and all. So putting that in the fourth quarter, do we see a good growth in the fourth quarter on YOY basis? So,
YOY basis, yes, we should see some good traction in Q4.
Okay, right. That's it from my side. Thank you very much.
Thank you.
Thank you. Our next question comes from the line of Prerna Jhunjhunwala from Elara Securities Private Limited. Please go ahead.
Thank you. So just wanted to understand our capacity. Currently, we are at how many machines and what kind of additions we are looking at over the next 2 to 3 years, and capex for this year and next 2 years.
So currently we are working with 3,400 sewing machine on an average. So with last quarter we were at 3,400, and by March we should be at 3,900, 3,800.
So that is the utilization, no? Or because we were at 5,100 is what I remember.
Yes.
Okay, and what will be our capacity for FY24 and 25? Are we looking at any additions?
Yeah, we are looking at addition also. But internally for us, we still have a good headroom to improve by another 20% on capacity utilization. And second also is that we are working on a second shift basis where we can look at, say, 500 machines of utilization on the second shift also is possible. So, and we are also working on the new project of Sivagasi, which could come by March. So next year, we feel that effective utilization in terms of the capacity could give us a growth of 15 to 20%, along with capacity addition also.
So what will be our effective capacity at the end of next year?
Of this financial year?
Yeah, after in FY24 and at the end of FY24, what will be our effective capacity?
The effective capacity utilization should be 4,200 machines on an average for the whole year.
So not utilization, actually I just wanted the total available capacity.
85 could be the right number.
No, sir, I'm not asking for percentage. I'm asking for the total number of machines that will be available.
4,200 machines on an average for the whole year.
Okay, that I get is the utilization. Understood, sir.
So like first April it could be 3,900 and March it could be 4,500. Average it should be 4,200 for the whole year.
Okay. Understood. And sir, I missed the order book number at the beginning, in the beginning speech. What will be our order book and how much that would service for how many months?
364 crores is the current order book, and it will be over a period of 4-5 months. Certain orders could be for 6 months also, but current order book is 364, and we have closed for the month of April.
Okay, understood, sir. That's it from my side, sir. Thank you, and all the best.
Thank you. Ladies and gentlemen, as there are no further questions, I now hand the conference over to the management for closing remarks.
Thanks for everyone's participation on the various questions. It shows the interest in your company here, and we are going very steady, and we are very clear about our plan. We have a very clear visibility despite the disturbances in terms of the logistics or any kind of if at all any recession or whatever it is. So, but still we have a very clear visibility of where we are heading to. So we are confident about the subsequent quarters to come. Thank you for your time. Thanks for the participation.
Thank you. On behalf of Elara Securities Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.